Can you see the presentation?
Yes.
Okay, thank you. I think we stopped here, right? What is this? This is net present value profile. The x-axis is the discount rate, y-axis is the net present value. So this is net present value profile. When discount rate is 0, net present value is the highest, right? With the discount rate increasing, net present value comes down. So when net present value becomes 0, that discount rate, we call it internal rate of return. So that's what I hope it is clear for all of you. So we'll go through this problem. A project has a total upfront cost of 435,440. The cash flows are 100,000 in the year 1, 200,000 in the year 2, and 300,000 in the year 3. What is the IRR, right? So we just learned IRR, internal rate of return. Internal rate of return is when the discount rate, when the NPV is 0. Okay, so we'll try to calculate that for this problem. So the information we have been given, we will put it on the board. So we have here the year 0, 1, 2, 3, right? I want you, all of you, to calculate and give me answers. So it says require 18% return. The required return is 18%. Then what is the upfront cost? Upfront cost is 435.
450.
435,000. 440. 435, 400. 440. Thank you. Then cash flow. Cash flow. What does it say? Year 1, 200,000. Right. So I think I wrote in at the wrong place upfront cost. I'm not writing it again. Upfront cost is here 435, 440. Okay. All these pins are again, you can't see. 435, 440. Then the cash flow is 100,000 in the year 1. This is 200,000 and 300,000. Now we have to do trial and error. Okay. So you do the calculation for discount rate 0 and tell me what is the NPV. Discount rate 0% NPV. How do you calculate? I'll take this also out. 400. How do you calculate? This is discount factor for 0, right? For 0% discount factor for 0 is 1. Here 0 is 1. Here 1, that is 1 divided by 1 plus 0 to the power 1. Okay. Then 1 divided by 1 plus 0 to the power 2. 1 divided by 1 plus 0 to the power 3. That is a discount factor. Okay. At 0%. Are you all calculating?
One 164,560.
Yes, very good. 164,560. So when the discount rate is 0, NPV is 164,560. Maybe we can draw the net present value profile also. So it is when 0, 164,560. It happens because all these are 1. Right? 1 divided by 1, all is 1. So you add, this comes to 300, 500, 600,000 minus 435, 440 is 164,560. Okay, very good. So we'll go to the next discount rate. So this at 5%. At 5% discount rate, what is the discount factor and then the NPV? Okay. So at 5%, I'll just this won't change. This is 1. At 5% discount factor is 140. It won't change. Even the discount factor is 50%. Okay. These discount factors change. 1 plus 0.05. Okay. 5% means 0.05. This to the power 1. So we don't write normally power 1. Right? So it's 1 plus 0.5. Then 1 plus 0.5 to the power 2. 1 plus 0.5 to the power 3. Okay. So what you do is calculate it and multiply this calculate, multiply, and then add. Anyone who can't understand or it's not clear, ask me, because if you don't know this, then you can't calculate NPV or IRR. And last time I told you, it is trial and error. So that's what we are now doing. We are calculating for 0, calculating for 5%, next again for 10%, and find out at what rate the NPV will be 0.
It's 100, 335, 25.
100, okay. Everyone gets that amount. You don't need the decimals. You can round off 100, 335.
Yeah.
I have got 100, 360, maybe you are correct. 100, 335. Now we'll go for 10%. 10%. That is 10% here. What should come here? It's a denominator, no?
1.1.
1?
1.1.
Yeah,
power
1.1. 1.1, correct. For year 2?
1.1 into power 2.
2. Year 3? 1.1 into power 3. Thank you very
3.
much. All right. Now calculate. To calculate the discount factor, multiply 100,000. So the discount factor for year 2, multiply 200,000. Discount factor for year 3, multiply 300,000. And deduct 435, 446.
46,152.
46,000, right? That is same as my 46,152. Next is 15%, right? I'll do it for 15%. I think all of you know 1.15. 1.15 to the power 2 and 1.15 to the power 3.
Zero 0.12.
Okay. So we'll 0.12, I say rounding off is 0.
Zero. Yeah.
Yeah. We'll do another one at 20%. 20%.
So isn't the answer 0?
Huh? Yeah, answer. We have got the answer already. We have got
15.
the answer. We'll just do another one just to get this net present value for 5. 1.2 to the power 2, 1.2. Okay. For 10, 20, 5, 15. Okay. For 5, it was 160, 100,000 people. By this. 10, 46. 15, 0, 20.
Thirty-nine 606.
39, yeah. Plus or minus?
Minus.
Minus 39, 606. So when you say the figure, you have to say plus or minus, if not, there's a big difference. Okay, thank you. So 39, 606 for like this. Can you all see the board clearly?
Yes.
And you can see this is the net present value profile. At 15, it is NPV 0. This is NPV, this is discount rate. Okay. So NPV 0. So what is the IRR?
15.
15%.
50%.
Okay.
You can see how the problem has been given so that you can get that 50. That's why this the upfront cost 435, 440. It is not a round figure. You know, normally you don't give investment cost like this 435, 440. So it has been done to get 15%. Right. Now, if we require 18% return, should we make this investment?
We should not.
We
No.
should, yes, because our return is 15%. But the return from this project is 15%, but we require 18% return, so we should not make this investment. Right? Shall I erase the code? Anyone wants to take it down? Okay. So we'll go to the next one, profitability index. There's a lot of calculations today. Okay. Now profitability index is, we take the present value of future cash flows, right? Now we take just an example. We have 100,000. We write down because it's investment in year 0. Okay. And then we have cash flows in 0, 1, 2, 3. Okay. We say 40,000, 40,000, and 30,000. So what profitability index is, we bring these three to present value. Okay. Investments, future cash flows divided by the investment. So we take these three, discount at our required rate of return, and bring it down to present value and divided by 100,000. So it is very similar to net present value, because in net present value, what we do is we take the investment and add to the present value. Now, here we take the present value and divide it by the investment. So it is called benefit to cost ratio, right? Because present value is the benefit and 100,000 is the cost. So it's called profitability index or benefit cost ratio, and very much related to NPV, and will give same results, same decisions, and easy to understand. Now, you know, net present value difficult to communicate. We can say net present value is 100,000, 50,000. But when you have a ratio, it is easy to communicate. Right? Then we can compare. We have a better profitability index or benefit to cost ratio that we will select that project. Okay. So it is useful. We say we have 1 billion investment funds and we have projects total cost about 2 billion. So when you have to select only two projects up to 1 billion. So you do the NPV and then you can calculate the profitability index, and which are having higher ratio, select out of the maybe 5 or 6 projects, we select 3 or 4 which are within the total budget. But when you have a mutually exclusive projects, can give wrong results, incorrect decisions. So we have an example. I have taken this from a book. So that's why different table number is there. Investment cost and present value of cash flows for 6 projects, right? So that's what we are going to do now. So we have the initial investment for A, B, C, D, E, F projects, then the present value of the cash flows generated. Then the next table is calculation of NPV and profitability index, right? So very easy. All of you can calculate from, if we say take we write it down A, B, C, D, E, F. Right? So the initial investment 100,000. 100,000, 150. Can you see one project there? One project only 10,000 initial investment. 10,000 and 200,000. So this is the initial investment. Then they have calculated present value of future cash flow. Present value of future cash. 120. So you're not helping me, no? You can tell me what to write here. Okay. Now we have the initial investment, present value of future cash flows, net present value. How do you get the net present value? From the initial. Yeah, tell me.
Present value of future cash flows minus the initial cost.
Okay, thank you. So we get NPV is 20,000. Tell me the figures. For B,
30,000,
30,000. Okay.
20,000,
20,000. Okay.
minus 80,000,
Minus 8. Right. Okay.
20,000,
20,000.
25,000,
25,000.
25.
I have written wrong number here. Wait. 280, 25,000. Okay. What do you think from this, the best project? Okay, we'll see. Now we will calculate the profitability index. Profitability index is divide the present value of future cash flows from by initial investment, right? So it's present value for A is 1.2. Okay. B 30,000, 180 divided by 150. What's the amount?
1.2.
Again 1.2. No? Then 20,000 divided by 220,000 divided by 200.
1.1.
1.1, no?
Yes.
Yeah, 1.1. 320 divided by 400,000.
0.8.
0.8. Then 30,000 divided by 10,000.
3.
3. Then 305,000 divided by 200.
1.09.
1.09. Okay. Now, what they have done is they have ranked the projects based on net present value and on profitability index. Right. On net present value, what is the best project? It is B. B is the best project with net present value. Then this one, 25,000 is second. Then these two are
C and E.
one.
A, C and E.
C and A is 3, no? C and A is,
C and E also.
oh yeah. Okay. C and A is 3. And the last one is minus 3, 4. Okay. Then based on profitability index, E is number 1 because it's 3. E is number 1. Then again there are 2 2s, no? A and B are 2. Okay, A and B are 2. C is 3, no? C is 3.
C is 3. 4.
4 and 5. Right. Can you see there is a, though they are similar, when you rank they are different, right? Okay. So my knowledge, E is the best because you invest only 10,000 and you get 30,000, right? That is 20,000 in NPV, and so we'll have to just this comparison and see what is the best project. So maybe you have to go by the profitability index ranking because NPV doesn't show how much you are investing initially, right? But profitability index, because you are dividing from the investment, you get the initial investment into the equation. So we have another, any questions from this? Another problem is we own one corner lot. I have been always telling about this corner lot to you, where we can build a gas station or an apartment building, right? So we'll assume A is the gas station, B is the apartment building. And what is the best option, right? So they have given cash flows, right? A, B cash flows for 4 years, right? Both are same investment, initial investment. Then IRR they have given, and the calculation of what we did earlier for each discount rate, NPV A and NPV B. right? So what do you think the best project? What do you think is the best project? I'm erasing this. When you are doing project evaluation, you get project with IRR 24% and IRR with 21%. Which project you think is better? So
A.
A, yeah, A. Based on IRR alone, it is A. But I'm going to explain to you, A is not the best all the time. Okay. A is on IRR is better, but our requirement we have to see. What is our required rate of return? Okay. So we'll again, I have to draw a graph with your help, right? So we take how do we take? Yeah, we take the discount rate and the NPV. Right? We take this is the discount rate. And this is NPV. So NPV is in the range of maximum 67. Five. So we'll draw this net present value profiles for both projects. So we take, so you tell me for A8 at 0, what is the net present value? 60. Okay.
60.
At 5%?
43.1.
43. 43. Somewhere here. 10%?
29.
29. Right. Then
7.
15%?
7.
15%?
7. NPV is 7.
17? No? Isn't it?
7. 7.0. 17, yes. This is the next one.
Okay. 20 only 7, no? 27.
Yes.
25? Minus
Minus 1.
Minus 1. So, very good drawing lines. Okay. This is A. Okay. A has a 24%. That's why 24% is the IRR. Okay. Then B, also tell me at 0, 70, huh? 0 for B, NPV is 70 at 0. Okay. At 5,
47.88.
at 5%,
47.88.
47.88 is more than the 7.8. Okay. Then 10,
29.79.
then
29.79. It's a little more than the previous one.
29.79. Then at 15,
14.82.
that is less than this, no?
Yes. Yes.
2, again 20,
2.3. Negative 8.
minus 8.
Minus 8.
Can you see now if our required rate of return, right, is less than 10%, okay, what is the best project? If our required rate of return is less than 10%, this is B. Then which will have the highest net present value?
Should be.
B. Yeah. So our decision will be based on our required rate of return. Right? If we our required rate of return is less than 10% or somewhere around 10 or 11%, then the B is the best. But after that point, after this point, if higher discount rate, A is the best. Okay. So when we are doing mutually exclusive projects, if not, we can do both projects if they are not mutually exclusive. Right? When we are doing mutually exclusive, we have to see what is our required rate. If the required rate in this instance is less than 10%, maybe 8%, then we have to select B. And if it is, if the required rate is more than 10%, that is maybe say 15%, then we have to select A. Okay. So that's what I wanted to explain. Hope it is clear. I think this net present value and other investment criteria is over. Now we go to the other. Can you see ratio analysis?
Yes.
Okay. So when we compare, now here this ratio analysis, we are normally doing with the financial statements. Right? And we discussed in project finance, when we start, we don't have financial statements, we go by cash flows. Right? But here we are doing it because we can prepare pro forma financial statements. We did it in our class some time back, right? So very easy to compare now, like the profitability index. If we have ratios, financial ratios, we can compare different companies, the performance. Okay, and the size doesn't matter. Now we saw that net present value calculation, that very small project was better than others because when you take that profitability index. So when the companies are different sizes, it is easy to compare them on financial ratios. And because it divide one by one, it takes out the size of the company. So what we are looking at, percentages, multipliers, or time periods, right? So the ratios are percentages, multipliers, how many times. Okay, percentage is what is the percentage. Then the time periods, we say debt repayment period, not debt repayment period. The debtors period is number of days, 40 days, right? Okay, like that. Then so financial analyst can decide on his own ratios. I have given you ratios here, but you can have any number of ratios depending on the way you are working on. So the financial analyst can decide on what ratios they are using. So when you are using these ratios, you should document how you are calculating each one, right? Because different people calculate in different way. If you document how you are calculating, then anyone can understand. So when we discuss these ratios, following questions come to us, right? when we discuss these questions come to our mind. You know, like our foreign minister, we can say when we lost something, then we won because we had the undecided people lost to our side, right? So always we should know how it is calculated. Then we know whether it is loss or win. The questions are how it is calculated. How is it computed? Okay. Second question is, what is it intend to measure? We have to know what is it intend to measure. Now we know if we take a thermometer, it's intended to measure the temperature. So if it is now everywhere we go, they measure our temperature when we go to supermarkets, all the places. So what is the purpose? Because they want to know our temperature, body temperature. What is intended to measure and why? Why might it be? Why might we be interested? Now, our temperature, those days we used to measure when we had a fever or body temperature. Now I think our lifetime we wouldn't have measured during this last year. During this last year, our temperature would have measured more than our lifetime. Right? So we have to know why is it intended to measure, what is it intended to measure, and why might we be interested. And third is, what is the unit of measurement? Unit of measurement. It is very important. Now I said unit of measurement can be percentage or number of times. What was the third one? Or multiple. Whether it is number of times or a time period. That is number of days or number of months. What is the unit of measurement? And then we should know what might a higher and lower number telling us. Now, the example I was taking, that body temperature checking at several places. And now if the body temperature is higher than some level, they will not allow us to go in. Right? So what might a higher and lower number telling us? So if it is higher number that we are having fever, so that we should not be allowed inside. So say similar, how might such value be misleading? Sometimes the value can be misleading. Right? And how can we improve this measure? How can we improve this measure? So those are the questions we will to come when we do ratios. How is it computed? What is it intended to measure? And why might we be interested? Right? What is the unit of measurement? And what might be a higher and lower number telling us? How might such a value be misleading? And how can we improve this measure? Now we take something like debt service cover ratio. Debt service cover ratio, how is it computed? How do we compute it? We compute it, we take the income before, what do you take?
Interest and tax.
Yeah, tax. And
Amortization.
we add tax again, no?
Profit before interest and tax.
Yeah, interest and tax. Yeah, before interest and tax, we get the income before interest and tax, and then divided by the interest amount for that period plus the installment. Okay, right. So that is how it is computed. So what is it intended to measure? It is intended to measure whether that the loan can be paid without difficulty, right? And why are we interested? Because we are giving a loan. We want to know whether loan can be paid from the cash flows of the company, right? Then the unit of measurement there is a ratio. Okay, it's a number, 1.2 or 1.5 or 2, right? So what might a higher or lower number telling us? So we know if it is less than 1, we cannot give a loan. Even 1 we cannot give because we are predicting cash flows, and these cash flows also can go wrong. So at least 1.5 should be there, or 2 is very much better, right? And how might such a value be misleading? Sometimes I can't get an example how we can say 1.5, but we have to see whether we have used the correct information, right? And how can we improve this measure? So we can do some other measurements also to improve this measure. So have you calculated these ratios? The examples I have given. So we are looking at 5 types of ratios: profitability ratios, efficiency ratios, liquidity ratios, gearing ratios. Those are, you can say, financing ratios, right? Investor ratios. So liquid ratios look at short-term solvency, right? And the gearing financing ratios look at long-term solvency, right? And financial leverage ratios. So those are called financial leverage ratios as well. I think we'll start calculating these ratios after the break. So after we start, we can continue from there. So we'll take the break a little early, and again, be ready to help me with the calculations. And there are 3 years given, I think, right? 2010, 11, and 12. That is the balance sheet. Then this profit and loss statement will only calculate for 2011 and 12, because 2010 also calculate some ratios, but if we know to calculate 1 or 2 years, that is enough, you know, then to calculate for any number of years, right? So then we'll see you in 15 minutes, 7:15 or 8:15, sorry. 8:15. Any questions? Today, number of participants are low. I think holiday season maybe, or the April Fools someone would have cracked April Fool and said there are no lectures today. I think April Fool's Day is nothing much because we are getting fooled every year at elections. No? Most of the elections we are getting fooled. So April Fool's Day is nothing compared to the election. We are getting fooled at elections. Okay, then see you at 8:15. So in this balance sheet, it is not balancing 1,455 and 1,812. So there is a correction. This should be 1,812, the total assets. Okay. And the total term funds cannot be 1,812. It is 1,627. Okay. Total term funds is 1,627. Right. So we will try to calculate our profitability ratios first. Okay. Profitability ratios 2011 and 2012. So we have to go to the profitability. Are you all there? Can someone speak?
Yes.
Okay, thank you. Right. Now we'll see 2011 and 2012. First is gross profit to sales ratio. Gross profit to sales ratio. So this is called gross profit margin also, right? Gross profit margin. So gross profit margin is gross profit divided by sales or turnover into 100. Okay. So shall we look at 2011 gross profit? Right. What is 2011 gross profit?
497.
497 divided by sales
2,800.
2,800. What is the answer? What is the answer?
17%.
Yeah, 17.75%. Okay. Right. Then the 2012, what is the gross profit?
973.
Okay. Divided by the sales.
3,200.
100 is 30.41. Okay. Correct. Why the gross profit margin is low in 2011? Why is that?
Sales low then.
One. Yeah,
The
profit
sales
is low.
figure is low.
Why is the gross profit low? If you look at the cost of sales, you can see one cost has gone up so much during that year. raw material consumed. Yeah, raw material consumed is like 1,500 when the turnover sales is 2,800. Now 2012 it is sales 3,200 and the raw material cost is 1,300. Maybe the raw material prices would have gone up, right? Some reason. Okay, so when we do the ratio, we'll have to see what has resulted, what has been the reason for the ratio changing, right? Because gross profit is normally won't change very much because the percentage is normally same. Then net profit. So next one is net profit to sales. So this is called net profit margin, right? Net profit margin. So I'm going into details for the benefit of everyone. Some of you must be specialized in ratio calculation, so excuse me. Gross profit margin, net profit margin is net profit divided by sales into 100. So shall we calculate net profit margin? Net profit is in 2011. What is the net profit?
87.
87. No? Okay. Divided by same thing, 2,800. And the answer is 3.11%. Very small net profit. And next year, what is the net profit? 520 divided by 3,200. You get 16.25%. So what is the message given here? So when you have sales of 1 rupee, 1 rupee sales, it generates just about 16 cents of net profit. Okay. So for the year 2012, when you have 1 rupee of sales, it generates 16 cents of net profit. So next one is return on capital employed. It is called ROCE, return on capital employed. Is the ratio net profit plus tax plus interest on term loans divided by when you take capital employed means both equity and term loans, because those both bring capital, right? So return on capital employed is you add equity plus term loans. The term loans is long-term loans. So what is the return on capital employed? 2011 net profit plus tax plus interest. Net profit is 87, tax is 1097, interest is 100, 197. 197 divided by equity and term loans. Where can we find equity and term loans? We have to go to the balance sheet. Right? So balance sheet, equity. We have total equity is 1,314. Term loan is 300. So we have 1,640. 1,640. If I am making a mistake, tell me, right? So what is the return on capital employed? 12.21. Okay, you know that 2011 is bad year for this company. 2010 was good, 2011 bad, again 2012 they have recovered. Okay. Then in net profit 520, tax in 2012, tax 58, that is 578, right? That is plus interest. What is interest? 80. 578 plus 80, 658. 658 divided by the total equity 2084 plus term loans 200, 2284. 2284 is equal to 28.81. I am correct. Are you also getting this same thing? Then this is last profitability ratio. There can be enough number of profitability ratios, but last year we are taking return on equity, ROE. What is return on equity? So equity should be the denominator, and the on top net profit plus tax. Okay, so net profit plus tax divided by equity. So net profit plus tax. Now we take the equity first. Since we are in the balance sheet, equity is 1,314. 1,314 and 2,084. 2,084. Net profit is 87 plus tax 97 and 578. 70 and 578. So we get 7.38%, 27.74%. You can see difference in 2 years, right? 2011 ratios are not good, but 2012 ratios are very much better. Right? Because of that, the raw material cost of raw material was high because of that. Now look at net profit to sales. Right? I have a question. If the margins are low, is it good or bad? If a company's margins are very low, net profit margins, is it good or bad?
It's bad.
Bad. Yeah, normally it is bad, but you know, some companies do with very low margin, but very high turnover. Right? So when you have very high turnover, even though you have low margins, then you get more profit. Okay, because the ratio gives only percentage. Depending on the, if you have a low turnover, then low margin is not good. But if you are very high turnover, then it is okay to have a low margin. Right?
It depends on the industry also, right?
Yes, based on the industry. Yeah.
The margins.
Yeah, tell me. Yeah, we can compare. We cannot compare different industries, right? When you compare these ratios, we should compare in the same industry. Then we can see if one company is not doing well or why it is doing better. with the ratios, right? Now, but as you say, if you compare two companies in different industries, the ratios will not be is a good way to compare. Okay, so always it should be in the same industry. Then the return on equity now measures how the shareholders have fared, right? Your shareholders' equity and shareholder gets a profit. Okay, so it is a measure how the shareholders fared during each year. So this year shareholders 2011 not fared well, but 2012 they have fared well. So according to accounting sense, ROE is the true bottom line measure of performance. Right? So we are getting the net profit divided by equity. So for how much we invested, what is the return we are getting? So for every rupee of equity invested, ABC is generating 7 cents in 2011 and 27 cents in 2012. So for every rupee invested, it's 7 cents in 2011 and 27 cents 2012. Any questions on these ratios? Okay. So shall we go to the efficiency ratios? Now you have that, you can see, have you taken a printout or something of this presentation? So then you will know what are the ratios we are looking at. Right? Now we look at profitable ratios. We look at these 4 ratios: gross profit to sales, net profit to sales, return on capital employed, and return on equity. Now we are going to efficiency ratios. How efficient the company is. Right? Okay. You want to look at this ratio side, or you want to look at the balance sheet and the P&L? I think since I'm writing the fund, since I'm writing the ratios, we'll go to the balance sheet, because even I need balance sheet and P&L. Okay. So efficiency ratios. First ratio is fixed assets to turnover ratio. Fixed assets to turnover. Right. Fixed assets to turnover. So fixed assets to turnover ratio is sales divided by net average fixed assets. So sales. What is the sales in 2011? 2,800. 2,800. And put down the 2012, 3,200. Net average fixed assets. How do you get the net average fixed assets? So we'll go to the balance sheet, right?
Balance sheet.
Yeah. Tell me net average fixed assets in 2011. That is the net average fixed assets in 2011. You can make a mistake, no problem. Okay.
It's 850.
Yeah, very good. Now, how did you arrive at 850?
You take the closing balances
Yeah,
of both years and then you add them up and divide them by 2. Divide the figure by 2.
correct. So that's why net average fixed assets, because this, balance sheet is balance at one day, right? So that is maybe 31st of December 2010 and this 31st December 2011. So 2010 is 900, 2011 is 800. We add, as you said, 1700 divided by 2, 850. So similarly, 2012. Now that's why we need the 2010 accounts here to get these averages. So 2012 net average fixed assets is
1000.
1000. Right. Okay. So this is coming to 3.29. Okay. And this is coming to 3.2. So what does this ratio indicate? What does this ratio indicate?
₹1 of fixed assets is generating a sale of 3.29.
Yes, correct. Very good. For every rupee in fixed assets, we generate 329. We generated 329 in 2011. We generated 320 in 2012. Right. Now, there is in the banks also we have a ratio. What is that ratio? I can't remember. Return on assets, right? And return on assets, we get credit lines. Right? We get credit lines, and the credit, we say ADB or World Bank, we say that bank should have a return on assets more than maybe 1.5, right? Okay. And when I was in HNB, we had a situation, our ratios went down even to 0.8 or 0.75, and we didn't get some credit lines. Maybe I also went to speak to ADB, but they said that's their criteria. So we did get some credit lines at that time because our ratios were bad. I think now HNB has very good ratios, but for banks it's around 2, 1.5 to 2. But if it is less than 1, means that you are not generating return on assets. Now here they are generating 329 on assets. This is fixed assets, right? Their return on assets is total assets. Stock turnover ratio. Stock turnover ratio. What is stock turnover ratio? Cost of goods sold. We can shorten form cost of goods sold divided by average stocks. So shall we calculate? For that we need the both are from the balance sheet. So we are in the balance sheet. Cost of goods sold. What is cost of goods sold? It is here. Oh no, one is from the
Yeah, from the
P&L.
cash flow.
Yeah, this is from P&L, cost of goods sold. So how do you get? It is not given straight away, right? How do you get? Now we have gross profit and we have sales. So cost of goods sold is the
Difference. Difference.
Yeah, the difference. What is the amount? Yeah, cost of goods sold. The difference is so it should be 1550, no? Is it? 1550. But is it correct? 1550. Cost of goods sold. 1500.
You're calculating for 2011, right? Not 2010.
Ah, sorry. That's the thing. I am wondering why.
2,800 minus 497.
497.
When I gave
2,303.
2303. Thank you. I should make a mistake, then you all will help me. 2303 divided by average stocks. Again, first we'll go to 2012 also. Cost of goods sold.
3,200 minus 973.
I mean to 2000.
227.
Now we go to the balance sheet. Average stocks. Now stocks. They have given finished goods, raw material, work in progress, right? So we'll have to add all those. No? So in 2010 it is 260. Right? In 2011 it is 315. Okay. So 260 plus 315 divided by 2. How much? You are not helping me calculation, so I'm writing that 260. The answer is 8.01. Then that is 315 plus 230.
348.
348. 348. Yeah. What's the 6.7? What does this mean? Stock turnover ratio. Stock turnover ratio means like we sold off or turned over entire inventory here 8 times, here 6.72 times during a year. Right? We sold off or turned over entire inventory 8 times or 6.72 times. So the next ratio is better. Stock resident period. Stock resident period. Stock resident period is number of days of the year. A year divided by stock turnover ratio. So it is 365 divided by 8.01. Come to 45.57, or can say 46, right? Days. And this one 365 divided by 6.72 is equal to 54.31 or 54 out of 54. Again, days. What is meant by stock precedent period?
So it takes 40, the average stocks remains in the warehouse for 45 days.
Yes, correct. Yeah. Stocks sits average number of 45 days in the warehouse before it is sold. Or it's 54 days in. Okay, we can say it is in the inventory for 54 days also, right? That is another way of saying it is after 54 days, one stocks come into the inventories, average going out. Right. Next one is debtor turnover ratio. Can you see at this level?
Yes, we can.
Okay. Debtor turnover ratio. Debtor turnover ratio is credit sales divided by average debtors. Now here it is from the balance sheet, the profit and loss, we can't find out whether these are credit sales or cash sales. So we assume that everything is credit sales.
Credit sales.
So credit sales is, this is 2,800. 2,800. The next year is 3,200. Average debtors. We go to the balance sheet. Average debtors. Can someone tell me what is the average debtors in 2011? Average debtors in 2011. $105 plus 150.
127.5.
How much?
127.5.
Right, 127.5. Thank you. 127.5. What is the answer? $21.96. 1.9. Then average debtors in 2012.
175.
And that's 150 plus 200 divided by 2, 175. We get the 18.28. So the next one is like the stock turnover and stock precedent period is, now we look at what is the I think the next issue is on the data side. We will see more important thing, right? So I'll erase the top one and write there. So data collection period. It is very important for a company to know how long it takes to collect data. Is number of days in the year divided by this ratio, data turnover ratio. Data turnover ratio. So it is 365 divided by 21.96. 21.96 is 17 days. Then 365 divided by 80.28 is equal to 20 days. What do you think? Seems to be better. No? 17 days, 20 days, they collect all their data. So what it means is we collect outstanding debtors within 20 days. It's take to 2012 during the year. Okay. So this one is 18.28 is we collect debtors 18.28 times during the year. Right? We collect debt 18.28 times during the year. That is, we collect average debt within 20 days. When we convert to days, it makes more sense, right? So stock resident period and debtor collection period makes more sense than the stock turnover ratio and debtor turnover ratio. So we know when we have this ratio 20 days, we have 20 days of worth of debt uncollected. Right? That is another way of putting it. I think we have a few more minutes. We'll do the other ratios next time, and I will again explain others who have joined late our program for this month. Right? So do you need holidays for New Year? Some of you must be planning to go on holidays, is it? Even I have a invitation to go on a holiday with some friends, still not decided. So we'll see. So the assignment, there is in the classroom, Mr. Menak have created a window for you to submit the assignment on 6th of April. That is our next class date, right? Before that, you can submit. And he has found out, we saw 2 of our participants haven't still gone to the classroom, right? So if you go to the classroom only, you get all these lectures we submit through the system. And on 8th of April, we have a guest lecture. Dhirunika Jayasinghe, Chief Manager Risk at HNB, who was former head of project finance HNB. She will be presenting risks in project finance. Right? So then the next week, that is Tuesday and Thursday of next week, that is 13th and 15th, day before the New Year and day after the New Year will be holidays for you. And I don't like to give holidays as well, because then you can lose interest on the program. But because of the festive season, we'll take a holiday. Right? Now today we completed the NPV and other criteria balance part, and we looked at the ratios. Okay. And we have to cover the liquidity ratios, then investor ratios and gearing ratios next time. And we'll start on a new subject also next time. Right. Good. We have 21 people still. Any questions? Gavin, any questions? Have you completed your
No, sir.
assignment?
Still doing, sir.
Yeah. Is that the project you are going to do?
As I told, it is orchid
Yeah, orchid.
plantation. Yes.
You know what
Okay,
I'm-
plantation in the greenhouse.
All right, right. So are you planning to do that project on your own?
In future, exactly.
sure, sure.
Yes.
You
Yeah,
know, we have
after my
yeah, go ahead.
after retiring from the banking system.
I thought you have resigned from bank. Where do you work now?
Now I am in Dubai actually. Hope I'm going to join with United Arab Bank.
You are in Dubai. Following the course from Dubai, is it?
Yes.
Right. That day you called me also from Dubai. Right?
No. By the time I was there, yesterday morning I came,
Oh,
and
right.
yeah,
Oh.
Sunday I have a second interview.
Oh, good. All the best. All the best. Hope you
Thank you so much, sir.
get the job. Very
Okay,
good.
thank you so much, sir. Thank you so much, sir.
See the enterprising person, Gamini. You see, he was following the course. Then he was calling me to get some information. Then he has already gone to Dubai to find a job. Anyone else? Always I ask Nuvani what to say. Or Tharindri.
Today you spelt my name. You pronounced my name correctly.
Today I pronounced correctly. Okay. Tharindri. Thank you.
So Tarindri, not Tarindi.
Tharindri, right?
Yes,
Tharindri.
yes. Many
Correct.
people call me Tarindi, and I find it a bit offensive. So
Tarindri. What is
Dri.
the name Tarindri? Right now, my name, my surname is Ennayakar. Lot of people, some people call me Henanayakar. Right? My former CEO Tyagaraja called me Henanayakar. Right? Some
Okay.
call Henna Nayakar. Right? Lot
Right.
of, so we should not take very serious. Right. Anyone else want to say anything?
So regarding the assignment, sir, now we have to look at it from the customer's point of view, right?
Yeah,
We
yeah,
have to pretend that we are the customer. And okay,
Yeah, you are the customer. You are coming to the bank to get a loan.
loan,
Project
right?
loan.
Okay.
You are submitting the project proposal.
Project proposal, right? Okay.
Yes. Okay. Good. All right. Then we'll call it a day. Right. And thank you very much for joining, and thank you very much for helping me to do the calculations. And see you on when?
Next
6th, no?
Tuesday, no?
Tuesday.
Six.
Next Tuesday.
Next on Tuesday.
Okay, have a nice weekend and long weekend. No, banks are on holiday tomorrow. Is it?
Yes.
Right, very good. All the best.
Thank you.
Good night.
Thank you,
Good night,
sir.
sir.
Good night.
Good night.